Look at a consolidated balance sheet. On the surface, it presents as a stable, unified structure, a single, solid block of assets, liabilities, and equity. That presentation creates a legal fiction. Consolidation treats a parent and its subsidiaries as one economic entity. It forces complex legal boundaries, distinct corporate vehicles, and individual risk profiles into one unified set of totals. This diagram illustrates the gap. On the left, measurement rules dictate the final numbers, but those fail to explain the economic risk mapped out on the right. IFRS 12 bridges these states, diagnosing the specific relationships and exposures hidden behind the totals. $1 billion in consolidated cash does not mean the parent company can freely access $1 billion, and $1 billion in consolidated assets does not mean those assets are legally available to service the parent's debt. To understand a corporate group's actual financial flexibility, analysts cannot take consolidated totals at face value. They must use the disclosures mandated by IFRS 12 to look past the surface and evaluate the underlying economic exposure. IFRS 12 applies after management determines whether an entity is controlled or if a joint arrangement exists. The standard focuses on the information users need to evaluate the nature and risks of those interests. The scope of the standard is broad. It covers subsidiaries, joint arrangements, associates, and unconsolidated structured entities. It targets any contractual or non-contractual involvement that exposes the reporting entity to variable returns. That includes ordinary shares, but it also captures liquidity support, guarantees, servicing rights, and subordinated debt. IFRS 12 forces companies to translate their mechanical accounting outcomes into risk-ready analysis. It requires the reporting entity to explain the economic substance of its relationships to the end user. How does an entity actually determine its accounting classifications before applying these disclosures? IFRS 10, 11, and IAS 28 evaluate raw data and route relationships into specific classifications: subsidiary, joint venture, or associate. IFRS 12 acts as an overarching lens sliding over these rigid classifications, demanding transparency into exactly how that sorting was done. The standard requires management to explicitly disclose the significant judgments and assumptions they used during the classification process. Correct classification under IFRS 10, 11, or 28 does not excuse an entity from disclosure. IFRS 12 ensures the logic behind the classification is exposed to both the auditor and the investor. Many preparers assume that a simple 50% voting threshold dictates control and risk. We must look at de facto control. Ownership percentages fail to tell the whole story. If remaining ownership is widely dispersed and passive, or historical voting dominance exists, a minority shareholder dictates activities. Thus, control exists, regardless of the mathematical threshold. The exact inverse scenario also occurs. A parent can hold 60 or 70% of the voting rights, but fail to consolidate the entity because a regulator or lender group holds substantive veto rights. Because these classifications dictate whether an entity's balance sheet is consolidated, boilerplate statements regarding control judgments are unacceptable. The specific facts, contractual rights, historical voting patterns, and barriers to power must be laid out. Control is qualitative, not mechanical. Users must see the reasoning behind these judgments to accurately assess organizational risk. If all assets and revenues are already fully consolidated on the primary balance sheet, why do we need to disclose further details about the individual subsidiaries? Because of the mechanics of consolidation. 100% of a subsidiary's assets and liabilities are reported, even if the parent only owns 60% of that specific entity. Look at this block of consolidated assets. When we apply the IFRS 12 X-ray, we isolate the non-controlling interests, representing the equity and profit that legally belong to outside minority shareholders. Analysts require these NCI disclosures to accurately calculate what portion of the net assets actually belongs to the parent shareholders. Without this breakdown, the group's performance appears artificially inflated. We see this illusion within consolidated cash. A massive balance can be a mirage. IFRS 12 mandates disclosure of restrictions. If capital is trapped across a border by capital controls or ring-fenced by a local regulator, the parent cannot use it. A technically compliant balance sheet is highly misleading if you do not know who truly owns the assets and whether they can actually be accessed. We move to the most risk-sensitive area of IFRS 12, off-balance sheet risk. Consider the structured entity, where voting rights do not dictate control. The relevant activities are directed entirely through predetermined contractual arrangements. Common examples include securitization vehicles, project finance companies, or asset-backed funding structures. Because voting rights are negligible, the parent company often avoids consolidating them. The massive risks they carry do not appear on the primary balance sheet. To address this blind spot, IFRS 12 introduces a mandatory metric: maximum exposure to loss. A tiny recognized asset can mask massive off-balance sheet exposure through liquidity facilities, subordinated support, or credit guarantees, forcing that hidden downside into the light. If an entity cannot quantify this maximum exposure, IFRS 12 legally requires management to state that fact in the notes and explain why. Quantifying worst-case scenarios proves that economic risk does not vanish simply because an entity avoids consolidation. Treating IFRS 12 as an administrative checklist defeats the entire purpose of the standard. The quality of the disclosure depends entirely on management's judgment regarding aggregation. Aggregation is useful when grouping immaterial interests to reduce clutter, but it becomes actively harmful when used to hide a high-risk structured entity inside a broad category. Mixing highly restricted foreign subsidiaries with unrestricted domestic ones destroys analytical data value. IFRS 12 relies on qualitative materiality. A small balance sheet amount remains highly material if it involves regulatory restrictions, unique loss-sharing terms, or severe downside risk. Grouping financial data must preserve clarity regarding risk and return. It should never be used to hide exposure for the sake of brevity. Ultimately, IFRS 12 is a framework for stewardship assessment. It allows investors and regulators to evaluate exactly how management structures the entity's activities and risk. Financial transparency requires explaining the economic relationships that generated the numbers, rather than merely presenting the final mathematical output. By diagnosing the underlying constraints, off-balance sheet exposures, and qualitative judgments, IFRS 12 closes the critical information gap. It proves that a company's economic reality is far more complex and vital than its consolidated totals suggest.